Good afternoon. My name is Juan Esparza, and today I'll be presenting Texas Instruments. It's firm valuation. Um, Kind of like the goal of this analysis is to estimate the intrinsic value of Texas Instruments, also known by TXN, using two of the most widely uh, commonly used valuation methodologies, which is like discounted cash flow valuation and a comparable company valuation approach. Um, And throughout this, well, through the end of the presentation, you kind of see how the different approaches, which are driven by different factors, how they could create such a different implied share price. Um, all right, so TXN, Texas Instruments, it's one of the largest semiconductor companies in the world. It was founded in the 1930s, so it's been around for a very long time. And it's a global leader in analog semiconductors and embedded processing products. It has over 100,000 customers across the globe. It operates in industrial, automotive, communications, and consumer electronic markets. Um, the most important part of the business is the analog segment, which currently accounts for 75% of the revenue, which is very impressive. And kind of like analog chips, what they do is they convert real world signals such as uh, temperature, sound, pressure, motion into actual real digital information that electronic devices can process. And these products have a very long life cycle, so it creates stable and recurring revenues for TXN. And the next most important part, our segment is embedded processing segment, which accounts for 20% of the revenue. And that includes microcontrollers and processors used in industrial and automotive applications. And I think some of what gives TXN its competitive advantage over other companies is that it owns a lot of its own proprietary fabrication facilities. Um, it has a very, very broad product portfolio, which is able to serve a wide variety of people, and it operates a direct sales force. So I think like with all these factors combined, they create kind of like a high barrier entry for other companies, and it allows TXN to maintain a very high cost advantage over like many of its competitors. So going to the financial forecast, um, revenue is expected to grow from approximately 7.7 billion in 2025 to approximately 33.1 billion in 2030. Um, EBITDA is looking to grow from 8.31 billion in 2025 to 16.5 billion in 2030. Um, and with very, very strong margins ranging from 46% all the way up to 50%. Um, and this results in like a very significant growth in profitability. Um, and also it affects the unlevered free cash flow, which grows from 2.9 billion all the way up to 9 billion. This growth in the free cash flow is ultimately what drives the company's value in the DCF model. Um, Overall, I mean, my forecast assumes strong but achievable growth, which TXN has showed in the past. Um, and you can just see some of the other stuff. It has a revenue compound annual growth rate of 13.35%. The effective tax rate is 13.09%. And it shows you the CapEx right there as well. Next up, I'm going to talk about the balance sheet, the deep dive. So one requirement for the project was to perform a deep dive into the asset and liability side of the balance sheet. Also, starting with the asset side, we're going to talk about CapEx and PPE. And in the sector that TXN operates in, they have that's very capital intensive. It requires very fast, decisive decision making into investing into new manufacturing capabilities because the products are always ever changing, especially in today's like AI driven world. Um, so yeah, so I forecast CapEx increasing from approximately 2.9 billion in 2026 to nearly 3.9 billion by 2030. And as a result, Net PPE grows by approximately 43% over the forecast period, reaching roughly 18.7 billion by 2030. And because CapEx uh, directly reduces FCF, the valuation is highly sensitive to these assumptions. And for the liabilities, I forecasted a gradual reduction in debt. TXN currently has approximately 14.8 billion of debt outstanding, and by 2030, I project that the debt will decline to approximately 9.7 billion. I think strong operating cash flows allows the company to repay the debt without significantly impacting operations. And as debt declines, interest expense also falls from approximately 596 million in 2026 to roughly 426 million in 2030. And ultimately, this just improves financial flexibility and gradually reduces financial risk over time. So now we're going to talk about the WACC, the weighted average cost of capital. And I estimate that to be about 9.44%. And this represents the minimum return that investors require given the risk profile of Texas Instruments. So to estimate the cost of equity, I use a CAPM pricing model, starting with a risk-free rate of 4%, a beta of 1.285, and an equity risk premium of 4.46%. I calculate a cost of equity of 9.73. For the cost of debt, I use TXN's average borrowing cost of approximately 4.91%. And after adjusting for taxes, after-tax cost of debt equals 4.27%. And then using market value weights of approximately 94.7% equity and 5.3% debt, the resulting WACC equals 9.44%. And this discount rate was applied throughout the DCF model to convert future cash flows into present values. And it's the next slide right here. So for the perpetuity growth method, um, the present value of the projected free cash flows from 2025 to 2030 equals approximately 25.5 billion. And to estimate the value beyond that forecast period, I applied the Gordon growth model using perpetual growth rate of 2.5%, and which is kind of like in line with long run GDP growth expectations. And the resulting terminal value is approximately 131.3 billion. And after discounting the amount back to present value, the discounted terminal value equals roughly 83.1 billion. And combining the free cash flows and discounted terminal value results in enterprise value of approximately 108.6 billion. And after adjusting for net debt and dividing by shares outstanding, the implied share price is approximately $108.57 per share, which is compared to the current market price of $288. This suggests the stock is significantly overvalued using these assumptions. And using the EV by EBITDA valuation, well, comparable companies valuation model, um, this approach, I got all the comparable companies, calculated the divided by EBITDA, got the average, and I ultimately got 21.61 for my multiple. Um, and this resulted in a terminal value of approximately 355 billion and an implied share value price of approximately $265 per share, which is while it's still below the current market price, the valuation is much closer to where the market currently trades. And so I calculated the perpetual growth rate implied by the exit multiple model by by using the Gordon growth model for growth. And I ultimately got approximately 6.83%. And this significantly shows higher than expected long-term GDP growth of around 2 to 3%. And this kind of suggests that the market is pricing in very, very optimistic assumptions about TXN's future growth, which it could hit. It's a very strong company and can't really rule anything out. Anything's possible. Um, and next up is the sensitivity analysis, and it just shows how sensitive the valuation is according to the assumptions. Um, on the table up top, we're using weighted average cost of capital WACC, and then on the top we're using the perpetual growth rate, and it shows with different WACCs and different perpetual growth rates what the price changes. Um, and on the bottom, the table uses the WACC and different exit multiples. So it shows like if the comparable companies I use, if the exit multiple had changed, um, and the WACC had changed, it would show like the different price that could have been, the different implied share price. And these are just some of the comparable companies I use: ADI, AVGO, Broadcom, NXPI, MU, Empower. It was kind of rough finding companies that were comparable because TXN has a very, very strong foundation and base, and it's kind of some of these companies are kind of up and coming, and due to like AI, they're rushing in, and just different points in the company, different timelines in the companies. So it's kind of tough finding comparable companies, but also able to manage. And just some of the key takeaways, conclusion, it kind of shows, like I said, the different valuation models had a very high spread. Um, the perpetuity growth rate implied a 62% discount compared to current market price, but the comparable exit multiple implied an 8% discount, which is very, very close to real price. It just shows that the difference between these approaches is mainly driven by terminal value assumptions and just the different drivers really affected the different valuation methods. But the market does appear um, to be pricing TXN based on a strong, strong future growth driven by AI, electric vehicles, and industrial automation. Um, and at the same time, TXN is helping its own future by investing heavily into the CapEx and heavy into fabrication and equipment. And they also been keeping very, very strong profitability levels and gradually reducing some of the debt that they have. Um, and overall, I honestly believe that TXN is one of the higher, if not highest quality semiconductor companies in the industry, and they have a lot of room to grow. But however, based on my valuation, I do believe that the stock appears to be moderately overvalued or over priced. Um, but I still believe that TXN has a very strong foundation, and they have a lot of room to grow, especially in today's economy. And personally, I would buy the stock. Um, and I think that in the next couple years that it will grow exponentially. That's about it. And I really appreciate your time and thank you.